Larry Shover. Larry, great to have you back on Market on Close.
Thank you so much. Great to be here. And it's hard to believe yields were 100 basis points higher the last time I was on with you.
Larry, what's the deal? Right now, we're looking at a market that seems, again, that bonds are kind of looking like the outlier here. First, it was the small cap move. Then you've got crude. Now you've got the overall global play through EM. It seems like everything's pointing to recovery here, except for bonds.
Yeah, that's right. And definitely some disconnects, but I have to say like stock sentiment isn't a proxy or even a good proxy for growth and inflation prospects going forward like bonds would be. I mean, when you have the head of the Fed saying that there's no accommodation on the horizon, it's almost like a rigged game, and you're going to see the front end of the curve down where it is today, 14.5 basis points, 100 basis points lower than February. And to get 10s and 30s to sell off or to get yields higher, it's going to require the stimulus that's in the system presently to cause inflation. And I think the thinking is the Fed will let that run a little bit. But other than that, it's almost a rigged game. There's a lot of cross currents, whether it be stock sentiment, whether it be the copper gold ratio. On the other hand, you have Brent below $60 a barrel, 45. That's not good. So it's the stock market's giving us a glimpse of what maybe could be, but it might be an illusion as well.
What's interesting, Larry, is some of the levels, the kind of absolute levels on these asset classes do still reflect the pain that that we went through and the uncertainty we're going through. You mentioned the price of crude oil is a good example. But the change and the rate of change, is it odd that bonds haven't even taken part in some degree of the trajectory? I mean, copper just rocking, new one-year high. Stocks are almost there.
Yeah, and copper is like another one where you really need to look into it and just keep in mind that China is putting out stimulus as well, a lot of stimulus, and that the direct beneficiary of that would be industrial metals, whether it be iron ore, especially copper. So that's part of the story. My proxy for growth is looking at front month Brent, and when it's 45 and not 60, the way it was back in February, to me, it's like I don't think there's a V-shaped recovery in the cards, albeit there is some pretty darn good stock sentiment in the world right now, especially in the U.S.
Right now, as we speak, stocks coming off a little bit, bonds just moved up a couple ticks. When you look at the potential for news to really shake this plateau, this sideways action, the range for bonds, what could it be? Is it confirmation that we're going to get the fiscal bridge extended? Is it some politically inspired infrastructure talk ahead of the election? It seems like they've been just injecting so much in, but nothing's doing it.
Yeah, you're right. And it's a little bit different than 2018. If you recall, stocks were the ones that caused the Fed to pause. It wasn't rates per se. And before you know it, we had, a series of cuts. But in this view, or my view would be that to get yields even lower, it wouldn't take a whole lot, although I don't think they're going to go lower or much lower from here. On the upside, I think it's a little bit more clear, and that is the stimulus that's in the system. If it does cause inflation, which no one seems to imagine, and that's typically when those kinds of things happen, that could get rates up. But by and large, I still maintain that we're going to see 10s drift higher between now and the end of the year, and the 210 curve will also go a little bit steeper, not just because I think there's going to be a recovery, but more just stabilization and more realization that if stocks continue to grind like they are, the 10s would have to be higher than 60 basis points.
So right now, with the bond market just silent, what about the information from Jay Powell on rates themselves? Because we've kind of left that beyond right now for the moment. It's just kind of left behind. We haven't had any indication of negative rates. The market was for so long tied to the direction of interest rates. If that doesn't move, should we expect, though, a further rally in bonds? Because it used to be the QE comes, the easy money, stocks, bonds, gold, they all rally together. But it probably behooves us to still point out that bonds aren't really rallying either.
No, they're not. You're right. They're in a really sleepy range. It's hard to watch them every day. I mean, I start looking at different asset classes. I just get so bored whether my computer's even working. But the fact of the matter is that the game has changed, and that the Fed made it abundantly clear that there's no further accommodation or lack of accommodation, no changes on the horizon. So to me, that's not weeks, that's not months, that could be years. I mean, unless something rears its ugly head like inflation. I think it's lower for longer. And a good indication of that is just you look at the MOVE index, which measures implied volatility and 10-year yield. It's at an all-time low, and it continues to hover that way. So no matter how you look at it, could yields go lower? Absolutely. But I think the path of least resistance is to move modestly higher between now and the next 6 months.